So today we're doing a Sunday video. We never do a Sunday video, so hopefully that's definitely worth a thumbs up. But today I'm going to share something really interesting with you. Some new data that's come out, and some data that basically, if you are invested in indexes or the big tech, you might not have noticed this, but definitely if you've been invested outside of the big tech and the S&P 500, you'd have noticed a few stocks haven't really done that well recently. And I think that because you see the S&P, you see all the headlines like stock market puts in new all-time highs, and so is putting in new all-time highs. You're looking at a couple of stocks that you own and you're like, well, they're not doing that. And I think the information that I have and found, and it was shared on the Discord actually, I'm going to share that with you guys and just kind of reassures you that it's not all okay out there. There's some things that are definitely not doing that well at the moment, so don't get too disheartened if you are investing in a couple of companies and you're seeing them companies like 20, 30, 40% down off all-time highs, because there's quite a few stocks that are struggling. There's a few stocks down at 52 close. So today I'm going to share this information with you, this new information about the Nasdaq, and hopefully you find it a little bit useful. Just to shout it out though, you might have not noticed this over the last week, but actually going into the first week of this year, the actual S&P 500 is down. So we are actually down 2.5% so far this year on the S&P 500, which is interesting to see the S&P 500 now just having a little bit of a cooling phase. Now, every time I have said this previously, what has happened is the S&P 500 has gone absolutely crazy after this, so we'll see where it goes. But going into 2022, I do feel like the S&P 500, the big tech, will have to have a cooling off phase at some point. Maybe this is it. Maybe it's just one of those periods where just for a week it quietens down and then boom, it goes on one. But this is what we've been talking about for such a long time. The S&P 500 is down so far this year. And why is it down? Because the stocks that make up the majority of them indexes, like Apple's down 5% so far year to date. The likes of Microsoft is down 6% year to date. The likes of Google is down 5.5% year to date. So it's not a surprise that we finally have a lot of these big weightings in the S&P 500 start going down this year, and it eventually goes down, even though there's been plenty of other stocks that have been down last year and it didn't do it, because these stocks went on an absolute tear over the last year period. I mean, look at that for Apple. Look at the likes of Microsoft, 44%. These stocks have done absolutely amazing, and now these stocks have been a little bit weak. You've seen it in the S&P 500. Don't know if that will carry on this year, but I thought I'd just point that out really quickly. It's not the point of the video, but I thought I'd just mention that right now. Now, about 2 weeks ago, I shared this information with you on this video, which is on December the 30th. Since then, there's some new data that's come out, and I'll share that with you. But this was about the NYSE, the New York Stock Exchange, and the stocks that were listed on there. Now, on this video, it does to go to say that last week, when the S&P 500 closed at 52-week highs, 334 companies trading on the New York Stock Exchange hit a 52-week low, more than double the amount that marked new one-year highs. So that was a big standout of the amount of stocks on the New York Stock Exchange that was falling off a cliff. The amount of stocks that were down at 52-week lows, even though the S&P 500 was doing absolutely amazing, there was a lot. There was a big, massive percentage on the New York Stock Exchange that had fallen off a cliff and weren't doing well, even though the stock market looked absolutely amazing. And this is from 2 weeks ago. Now we have some new information about how disconnected that the stock market is from all the stocks out there at the moment. So this graph was shared by Albert in the Discord. Now this basically goes on to show the percentage of stocks down 50% from 52-week highs. So 50% obviously is a huge amount. You imagine you have an asset and that asset loses half its value. That's a massive fall off a cliff. Only really in the stock market you can get moves like that. You imagine if you bought a house and then it lost 50% of the value over a 3-month period, you'd be like, what has just happened? So yeah, this is the thing with the stock market, especially with individual stocks, is that you can have this ability for stocks to drop this much. But realistically, when you look around at the world right now, when you look at the S&P 500, you look at the headlines, you would not think that we have the percentage of stocks down on the Nasdaq down 50%. We're up to nearly 40%. You wouldn't think that is going on right now, because there's hardly anything out there talking about, oh, we're in a stock market crash, or this is crashing. There's not really much out there, because like I said, you look at the big tech are up, the S&P 500, and that's what matters. Until they fall off, then we won't be talking about how badly things are starting to go on with the New York Stock Exchange, what is going on with the Nasdaq. And what is really crazy is to see how high this is. If you look at this here, to be up this high is is crazy. I mean, the last point we were at this sort of here is that you look here at the spike here, which was the CV. Now I reckon probably I would say probably 50% of you guys that watch my videos have been investing since the CV dip or have gone through the CV dip. And that was a really quick dip. That was a dip that like you were on your account every day and your account was like down 10% pretty much nearly every day. It was awful. It was an awful crash, but it did recover very quickly. That was a little bit of a difference, I guess. But you look here, you know, that really on that peak day. I don't know if any of you guys remember that peak day in the CV times, but that was just that was definitely a bloodbath day. And the next day, it was just such a quick reversal. Like a lot of stocks were up a huge amount. And on that day, that's when we touched 60%. You know, we're only 20% off that point. That's how crazy it is. You know, if you guys remember how much of a bloodbath that was, look how close we are actually to that point. It is kind of scary here. And the next point here that we were at was 2018. I don't know if any of you guys were investing then. I'd probably say that 1% of you guys that maybe are watching this video watched me back in 2018. But yeah, 2018, I remember going through that crash. Like it got to December, everything just absolutely fell off a cliff. I think it was the worst December on record, I think it is. Or the worst December since the Great Depression or something. It was a December that was absolutely terrible. Like the whole year was like sluggish, and there was a lot of concerns with China and economies slowing down and everything like that. And it just kind of got to December and everyone went, oh, I'm just going to sell out, and everything just drops like huge amounts, like, you know, 30-40% in December. And that was a really good period, and that was December was at one point was actually going to be recognized as a stock market crash. Like this was recognized as a stock market crash, but December 2018 was very close to being a stock market crash. I think at one point it did go into the S&P went nearly down 20%, but by the time it closed, I think it closed at like 19.9%, so it never actually got recognized as a crash. But that was pretty much near a stock market crash there. Obviously, you guys know this is a stock market crash here. So the last two times we have been over or near it were both stock market crashes and recognized by the S&P 500. The only difference is that we're here, and the only little difference you don't have is the S&P 500 isn't down. You know, the big tech isn't down. You imagine if the S&P dropped 20%. You imagine if Microsoft, the likes of Nvidia, the likes of Google, Apple, imagine if they were down 20% right now. Imagine where we'd be at. We'd generally be probably up here. That's how bad it is out there right now. And then I think the other last time, until you get all the way back to obviously 2000, 2008, 2009, is around about 2015, 16, and that was a bit of a slugfest in the stock market. That's only when I started to learn how to invest, and I was trying to pick a few things up, and I think there was a lot of things going on at the time with Brexit. I think there was a few things with China and their economy slowing down. There was, I think, Greece at the time were obviously in another problem. Once again, sorry Greece, but economically I think they were having a lot of financial troubles. So they were having a lot of problems. So there was a few general problems out of the world, and that caused 2015, 16, and to have not really a great period of time. So that was the last time. But you see here that there's really major events when the last time we're at these sort of point of views, and it is crazy to look at. This is how bad it is right there, right now, and everything like that. So, you know, don't get too upset because the S&P 500 doesn't suggest anything like this. It's not being talked about because they're all doing amazing, but it shows you how bad things are outside of the S&P 500, outside of the big holdings, to be at these sort of levels. So if you have stocks that are, you know, not doing that well outside of them, don't get too upset because it's not you. It's generally the stock market. It is a bit of a tricky time right now for a lot of stocks at the moment. So if you've seen stocks down, if you have stocks that have gone 50% down over the last 1 year period, it's not something to be upset about. It's just generally what the market's going on right now. And the last thing I'm going to finish off with on this point of view here is that when you look at all these points here, if you look at this point here, 1, 2, 3 here, so the last 3 times we were up at where we had so many stocks down, when we had this amount of stocks down so much, what happened? 2017, really good. That was my first full year in the stock market, and it was amazing. Stocks did absolutely amazing, and that was after this one here. 2018, when we had the December fall off, what happened after that? 2019 was a fantastic year in the stock market. The stocks did really good. The 2020 CV dip, what happened? Stocks did absolutely amazing through 2020 to into 2021. So we had a massive rally. So same again when we get to this point here, just saying, when we've been at these sort of points historically, when it eventually peaks out, what tends to happen? We do seem to go on quite a decent rally. So we never know. You know, that's what is set up to potentially happen if we go off what has happened in history. And the big thing is that when you go through all these things, whether or not you owned, you know, a good company in these sort of periods and it lost a lot of value at this point, it lost a lot of value in 2018, it lost a lot of value in 2020. These are all short-term blips as a long-term investor. This is the big thing. If you bought a stock in 2016, 2018, 2020, as long as you're buying great companies, they will turn around and they will come back in favor. And this is what you've got to handle as a long-term investor. You will have these sort of episodes where stocks fall off a cliff. It will happen. But if you look at a lot of stocks from 2016, you know, them great companies, what have happened? Them companies have gone on crazy runs. You know, the likes of 2018, if you bought in there, for me personally, I was buying the likes of Microsoft, which obviously is a great company. I was buying a Chinese company called JD.com, which went on to do absolutely amazing as well, and a few other stocks. But you know, those are two stocks that I was buying a bit heavy in that period of time, and two great companies. One of them, obviously, Microsoft, one of the big techs. But JD.com, you know, that stock got absolutely hammered. It went from like $60 to down to $20. A lot of people saying that, oh, Chinese stock and everything, China economy slowing. A lot more FUD about that one now. But you look at the rewards from that one, you know, that stock was up 300-400% from that point of view. And he's saying with 2020, you know, some of you guys might appreciate that one because you've been through it. You know, what benefits did that give you if you bought in that dip? If you bought some great companies, you're probably up on them great companies. You know, you've probably done really well from buying in that dip. So, you know, more than anything, it is a tough period of time. It is important to share this so you realise that. And also important to say that sometimes as well, these are the times where you start buying great companies at very cheap prices, and then when the market does turn, you know, you have the benefits from that. So hope the video was useful, hope the Sunday video was useful. Just to let you know, if you're on the Patreon, there's an exclusive video out there. It's called the 100 Baggers book review. So it's a book that is talking about how to get 100 times your return on investments over a long period of time. Very good book. If you're on the Patreon, I have reviewed that, so do go check that one out. It's about half an hour long, and we talk about some of the principles in that book. But apart from that, if you do want to start investing, there's some links in the description to some brokers, and if you join them, you can start investing. But I hope the video was useful. Hit that like button if you're new, subscribe, and I'll see you in the next video.